Imagine walking into a dealership and buying a $50,000 car. From your side of the desk, the business seems obvious. The dealer acquired the car for less than $50,000. You paid $50,000. Whatever sits between those numbers must be the profit. Except your signature on the purchase agreement may only be the beginning. Maybe you finance the car. Maybe you trade in your old one. Maybe you buy a service contract. Maybe you return for maintenance, brakes, tires, and repairs for the next 5 years. And your trade-in. The dealership may recondition it, sell it to somebody else, arrange that buyer's financing, sell them protection products, and eventually service that vehicle too. One customer, one new car, but potentially 5 or 6 different ways to make money. Which raises a strange question. What if the car itself isn't the most attractive part of the transaction? Because a modern dealership isn't really one business. It's several businesses operating under one roof. And the first clue is sitting outside in the parking lot. Millions of dollars sitting still. A franchise dealership can require enormous capital. There is the land, the showroom, service base, diagnostic equipment, employees, insurance, advertising, working capital, manufacturer standards, and, most visibly, the inventory. NADA data shows that the average U.S. franchised light vehicle dealership generated roughly $76 million in sales in 2025. That is revenue, not profit, and dealers usually don't pay cash for every new vehicle sitting on the lot. A large portion of inventory is commonly supported through floor plan financing. Think of it as a revolving credit line for vehicles. The car arrives. The dealer finances the inventory. When the car sells, that financing gets paid down. Simple. Except there is now a clock running. Interest, insurance, depreciation, storage, and the risk that next month's incentives make today's vehicle harder to sell. Large dealer group Lithia reported nearly $70 million in floor plan interest expense in Q2 2026 across its network. So a row of unsold SUVs isn't just wealth sitting on asphalt. It is inventory costing money every day it fails to move. That creates the first rule of dealership economics. A car can become more expensive the longer it sits still. So dealers need to sell cars. The surprising part is what happens after they do. The business everyone thinks they understand. This is the familiar part. MSRP, discounts, manufacturer incentives, negotiation, and eventually the difference between what the dealership has in the vehicle and what the customer pays. That difference contributes to front-end gross profit. And yes, dealerships absolutely can make good money selling new cars, especially when inventory is tight, demand is strong, or a particular model is scarce. During the vehicle shortages of the early 2020s, dealers had extraordinary pricing power. Cars sold quickly. Discounts disappeared. Some vehicles sold above sticker. But those conditions were unusual. By 2026, inventories had largely recovered, incentives had returned, and competition had normalized. At Lithia, for example, Q2 2026 new vehicle gross profit averaged roughly $2,700 per vehicle, with gross margin around 6%. So imagine selling a vehicle for close to $50,000 and generating only a few $1,000s of vehicle gross profit before payroll, real estate, advertising, inventory financing, and the rest of the dealership's operating costs. Still valuable, still necessary. But now the customer enters another room, and suddenly the economics change. The room after the negotiation. You agreed on the car. You agreed on the price. Psychologically, the difficult part feels finished. Then you enter F&I, finance and insurance. The dealership may help arrange your auto loan through a bank, captive finance company, or other lender. Depending on the lender, transaction, applicable rules, and state law, the dealership may receive compensation for arranging that financing. Then come optional products, extended service contracts, gap protection, maintenance plans, vehicle protection packages. Some of these products can provide legitimate value. Customers can also decline them. The important point is economic. The dealership has a strong financial incentive to sell them. At Lithia in Q2 2026, F&I gross profit averaged roughly $1,800 per retail vehicle. Now compare that with roughly $2,700 in new vehicle gross profit. Think about that. A customer might spend half an hour negotiating another $500 off the car, while a separate profit center worth a significant amount can appear after the selling price has already been agreed. The sticker price negotiation feels like the main financial event. It may not be, and there is still another transaction happening if you drove into the dealership in an old car. The car you brought with you. Suppose you trade in your current vehicle. The dealership is now conducting two deals simultaneously. Is selling a car to you and buying a car from you. Trade-ins are extremely important because they supply a large share of the used vehicles franchise dealers eventually retail. That means the dealer isn't simply trying to close one sale. It may also be acquiring its next piece of inventory. Imagine negotiating $1,000 off the new vehicle. You feel like you won. But suppose two reasonable appraisals of your trade-in differ by $2,000. Suddenly, the number receiving the most attention isn't necessarily the number having the largest effect on the overall deal. That doesn't mean every trade-in is manipulated. It means several prices are moving at once. Purchase price, trade allowance, financing terms, optional products, and potentially the future resale value of the car you just handed over. Once the dealer owns that trade-in, it has another decision to make. Retail it, wholesale it, send it to auction, spend money reconditioning it, hold it, lower the price. And if the dealer does sell it to another customer, that second transaction can create another loan, another F&I opportunity, another service customer. Your old car can become the dealership's next product. But the biggest reveal comes after both customers leave. The department that changes the entire business. Oil changes, brake jobs, tires, diagnostics, warranty repairs, replacement parts, mechanical work, collision repair at some locations. The service department usually isn't the glamorous part of a dealership, but financially it can be extraordinary. In 2025, U.S. franchise dealerships handle more than 276 million repair orders and generated more than $164 billion in service and parts sales. But revenue is only half the story. The real surprise appears when you switch from revenue to gross profit. Take Asbury Automotive Group in Q2 2026. New vehicles generated more than half of company revenue. Parts and service generated only around 15%. So from the revenue statement, the business looks exactly like you would expect. A company that sells cars. Now look at gross profit. New vehicles contributed only about 18%. Parts and service contributed almost 50%. F&I contributed another roughly 23%. That means for Asbury in that quarter, parts, service, and F&I together produced almost 3/4 of gross profit while accounting for less than 1/5 of revenue. That is not a universal formula for every dealership. Different franchises, markets, and dealer groups have very different economics. But other large public groups show the same basic pattern. Vehicle sales dominate revenue. Service, parts, and F&I can contribute a disproportionately large amount of gross profit. Service and parts gross margins at major public dealer groups can approach 60%. Compare that with roughly 6% on new vehicles in the Lithia example. And suddenly the entire business looks different. A dealership may sell you the car once, but it could potentially service that car dozens of times. The car brings the customer into the system. The service lane keeps the relationship alive. Follow one customer through the machine. Let's follow one fictional customer. These numbers are illustrations, not industry averages. You buy a $50,000 car. Maybe the dealer generates roughly $2,500 in front-end vehicle gross profit. Then you finance the purchase and buy optional products. Maybe another $1,800 of F&I gross profit. You also trade in your old vehicle for $18,000. The dealer spends money reconditioning it, then sells it to somebody else for enough to generate another gross profit opportunity. That second buyer may finance the car too. They may buy service contract, and they may return for maintenance. Meanwhile, you return with your new car. Oil changes, brakes, tires, repairs, replacement parts. Then, 4 or 5 years later, something even more valuable happens. You come back. You trade that same $50,000 car in and buy another one. Now look at what began with one vehicle purchase. New car, loan, F&I products, trade-in, used car inventory, second vehicle sale, service, parts, another trade-in, another new car. That is the economic machine. The dealership is not merely trying to earn one margin from one car. It is trying to turn one transaction into a relationship containing multiple transactions. Multiply that across thousands of customers and many years, and the dealership stops looking like a car store. It starts looking like a customer lifetime value business built around automobiles. But there is a reason those extra profit opportunities are valuable. They also carry extra risk. The used CR gamble. Used vehicles can sometimes offer better gross profit opportunities than new vehicles. But they can also be much harder to manage. Every used car is different. Mileage, condition, accident history, local demand, reconditioning cost, wholesale value, and what the dealer thinks it can sell the vehicle for today may not be what somebody will pay 30 days from now. Imagine buying a used vehicle expecting to retail it for $40,000. Then demand weakens. Comparable vehicles fall. Now the market says $37,000. A large portion of the expected profit just disappeared. Meanwhile, the vehicle is still costing money to hold. That is why dealers obsess over inventory turn. A vehicle with a potentially large margin can become a terrible investment if it sits too long. Higher margin does not mean lower risk. And that helps explain why manufacturers still rely so heavily on dealerships. Why the dealer still exists. A franchise dealership isn't simply a store that borrowed a manufacturer's logo. The manufacturer supplies the brand, vehicles, national advertising, warranty programs, training, technology, and operating standards. The dealer supplies something equally important: local capital, real estate, employees, inventory financing, test drives, trade-ins, vehicle delivery, service base, warranty repairs, used car operations, and long-term customer relationships. Direct sales companies have shown that manufacturers can structure this differently. But eliminating the traditional dealer does not eliminate the functions. Somebody still has to take the trade-in, deliver the car, arrange financing, repair it, handle warranty work, stock parts, and deal with used vehicles. The dealership bundles all of those messy local jobs into one business, which finally brings us back to the original question. So, what business does the dealer actually own? From the road, a dealership looks like one business. Inside it, there may actually be several. New car retail, used car retail, vehicle acquisition through trade-ins, finance and insurance, service, parts, collision repair, and underneath all of them, customer retention. The vehicle still matters enormously. Without the car sale, there may be no loan, no trade-in, no service relationship, no future replacement purchase. So saying, dealers don't make money selling cars, would be completely wrong. They do. Sometimes they make excellent money. But that is not the interesting part. The interesting part is that the car can be only the first profit event. You walk into the dealership thinking, I'm buying a vehicle. The dealer may see a vehicle sale, a loan, a trade-in, a used car acquisition, an F&I customer, a service customer, a parts customer, and eventually another vehicle sale. That is why the most expensive thing in the building isn't necessarily the thing with the most attractive economics. The car gets you through the door. The real value of the dealership is everything that one car can cause to happen afterward.